AI isn't just supercharging stocks, it's secretly rewriting the bond market. Mega cap tech may be about to flood investors with new debt, pushing yields even higher as the Fed cuts. If you think bonds have no story, wait until you hear this one. You think about bonds, but not too much. You know that they're important because your favorite financial blogger and content creator, Mark Malek, is kind of obsessed with them, amongst other things. He got his start on a bond trading desk over a quarter century ago, where he learned that bonds offer the most direct reflection of the economy and global markets. He learned that bonds trade very rationally, and we like rational. He also learned that it's really difficult to keep a crowd entertained by talking about bonds. I'm sorry, everyone wants to talk about stocks. But stocks have great stories and bonds really don't. Now, sure, there are corporate bonds that come with stories about the companies that issue them, but that's pretty much where it ends. When you see NVIDIA's Jensen Huang in his leather jacket, calm, collected, focused, you pay attention. When you watch Palantir's Alex Karp with his unkempt curls and quirky mannerisms, wax philosophical, and simplify the complexity of data and AI with complete resolve, you pay attention. You don't immediately run to your Bloomberg terminal and look up NVIDIA's or Palantir's bonds. No way. You go straight to their stocks. Of course, there are almost unlimited upsides with stocks versus the very definite returns from bonds, though bonds can get capital gains if sold before maturity. Despite all this, you probably own lots of cool stocks that come with some pretty cool stories, along with some eye-watering capital gains. You probably own some bonds as well, because you know that diversification is important. You hear it here all the time. If you're my age, you probably own or certainly have owned individual bonds. If you're a millennial or younger, well, your exposure to bonds is most likely through a bond ETF. And that's okay. We'll take that because some exposure is better than none at all. Okay, enough of this. Are you tired of seeing bonds go nowhere for the past 3 years? Well, let me clarify that sweeping generalization. I'm talking really about 10-year yields, which spiked from less than 1% in 2020, which were all-time lows, to north of 4% starting in late 22. That was when the Fed went on its rate ratcheting, inflation-busting crusade. Since then, despite inflation receding and the Fed easing, rates have pretty much remained range-bound around 4 to 4.5%. Shouldn't rates come down and prices go up for you non-bond types? One of the principal reasons that long maturity yields are so sticky is the deficit. Yeah, you heard me correctly. I'm sure you've heard that the federal deficit is a problem. To clarify, its existence is not necessarily a problem, but its size and the rate at which it's growing kind of are. When I say problem, I'm not referring to the anecdotal criticisms. I'm referring to the very practical problem of how the government pays its bills. Not unlike you and me, if the government wants to spend more money than it has, it's got to borrow. It borrows that money by issuing bonds through the Treasury. If the deficit is rising, the government must borrow more, issue more Treasury bills, notes, and bonds. And when that happens, basic economics simply takes over. You know, supply and demand. When supply is swelling, prices go down. When bond prices go down, yields go up. The government is borrowing more and expected to borrow even more to continue funding the deficit. That's perhaps the principal reason for why yields have been so stuck in the mud. Now, I don't want to get into all the negative effects of higher mid to long-term yields remaining elevated, but you know the usual suspects. Mortgage rates, HELOCs, auto loans, they're all tied to those Treasury yields. They've eased a little bit, but they seem stuck in like some sort of suspended animation. But that may all be changing, according to a report issued by BlackRock, and it may not change for the better. And the BlackRock report doesn't point the finger at the usual suspects. It's not about inflation refusing to die, or the Fed being too slow on the rate cut trigger, or even the deficit itself, at least not exclusively. Instead, BlackRock raises a new wrinkle that feels almost counterintuitive at first. AI. Yup, the same AI that's launched trillion-dollar market caps into orbit and powered one of the most powerful equity rallies in history. It's quietly messing with the bond market in a far less glamorous way. Look, AI infrastructure is so capital intensive, so electricity hungry, so compute expensive that it's about to unleash a wave of new borrowing. And not by distressed companies or zombies, but by some of the healthiest balance sheets on the planet. That sounds like a strange risk to highlight. After all, companies like Nvidia, Microsoft, Amazon, Alphabet, Meta have cash piles that can make a sovereign wealth fund even blush. These aren't shaky borrowers. They're not clutching their hats and begging the bond market for survival. Their debt metrics look nothing like the bad old days which we had covenant-light loans. So why would their AI ambitions matter for the 10-year yield? Well, the answer is beautifully unsexy. Supply. This is where the bond story actually becomes interesting because BlackRock is saying the quiet part out loud. Even if the borrowers are pristine, even if the credit market is minimal, issuing more bonds still increases the total supply of debt sloshing around in the system. When supply rises, just like with the deficit, prices fall and yields rise. It doesn't matter that the issuers are AI heavyweights. The market only cares how much paper is hitting the street. And in BlackRock's view, we're on the cusp of a secular surge in corporate bond issuance directly tied to the AI build-out. Think about it. AI is not a product in the traditional sense. It's not software that costs pennies to run. AI requires enormous upfront capital, data centers, chips, thousands of miles of fiber, new power infrastructure, cooling, real estate, and cloud capacity that makes prior generations look like child's play. Capital's got to come from somewhere. Some of it's going to come from retained earnings, but most of it's going to come from the bond market because debt is still the cheapest and most efficient way to fund long-duration projects. So now you have two forces pressing on the same pressure point. On one side is the government, floating trillions in new treasury issuance. On the other side, you got big tech, about to join the party with record corporate issuance to fuel an AI supercycle. Both feed into the same marketplace, both swell the supply of bonds, and both are likely to keep upward pressure on long-term yields, even if the Fed cuts rates or if inflation drifts lower. The Fed controls the front end of the yield curve. The back end belongs to deficits, issuance, and global demand. And right now, issuance is winning. And let me be very clear. The problem is not the companies. There's no crisis brewing in Silicon Valley's credit departments. No CFO is sweating bullets over debt service. These are some of the most profitable enterprises in human history. The fundamentals are fine. The risk is not credit. The risk is just simple, stupid math. When you flood a market with more bonds, treasuries, investment-grade corporates, utilities, data center REITs, everything, the price of money rises. The bond market doesn't ask why. It only counts how much paper exists relative to the demand that's out there. And that's where this gets fascinating for a bond nerd like me. Suddenly, bonds do have a story. Not a melodramatic story about earnings or a CEO making a weird comment on TV. A macro story, a structural story, a supply and demand story, a story about how one of the biggest technological revolutions of our lifetime is quietly shaping the cost of capital, the yield curve, and the valuation metrics that determine stock prices. It is, I dare to say, a pretty cool bond story, an AI-related bond story, a story where the plumbing matters just as much as the glitzy tech everyone is so obsessed with these days. You're not going to hear this on TikTok, but it is one of the most important market dynamics of the next decade. Because if the AI capex boom is as large and persistent as many expect, the supply of long-dated corporate paper is going to rise in tandem. And that means yields may not fall in the clean linear way that everyone hopes as the Fed continues its easing cycle. And here's the kicker, the part equity-only investors are probably ignoring right now. Higher long-term yields don't just make mortgages more expensive, they also raise the discount rate that determines the present value of future cash flows. And which stocks rely most heavily on far in the future cash flows? You guessed it, growth stocks, tech stocks, AI stocks, the exact companies driving today's rally. So before you shrug off the 10-year yield and assume that it's stuck forever, remember that yield moves hit equities directly too. When the market starts paying attention to that, things can get pretty interesting pretty fast. So yes, bonds have stories. You just have to know where to look. And right now, the bond market is whispering something important about AI, about supply, and about how the next leg of this market may depend on which side of the balance, stocks or yields, wins the battle. So your truth bomb for today is this. When you follow the money, sometimes the biggest tech story is actually hiding in the boring bond market. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.